All right, folks, I'd like to go over another schedule of cost of goods manufactured, cost of goods sold, income statement problem with you. Remember that these schedules are dealing with the flow of costs. They are the financial statement representation of T accounts. And they are also dealing with these inventory accounts, the physical flow of these goods. So we have the information from the Mason Company. We have our sales, which we're going to need for our income statement, our direct labor costs, raw material purchases, so forth and so on. We have our inventory accounts here. And remember, with these inventory accounts, we've got a starting point, an ending point. We're going to have amounts that flow into these inventories and that flow out. So as you can see here, we've got to figure out, we've got to compute, we've got to prepare schedule of cost of goods manufactured, schedule of cost of goods sold. It also tells us a couple things, that raw materials are all direct materials. All raw materials used are direct materials. We have no indirect materials. And that we're going to close out any over or under applied manufacturing overhead to cost of goods sold. And finally, we've got to create an income statement. So let me get this out of the way. I've already laid out my schedules here. Now, keep in mind that our ultimate goal is to figure out net operating income. Ultimately, we want to get down to this bottom line. To do that, I need to know my cost of goods sold. To determine my cost of goods sold, I'm going to need this schedule of cost of goods sold, because it's going to tell me what did we start off with in finished goods, what flowed into those finished goods inventory, what was the amount left over, and then that's going to tell me what flowed out, cost of goods sold, and then went into the income statement. To get cost of goods sold, I need to know my cost of goods manufactured. Now, cost of goods manufactured is dealing with work in process, and because work in process consists of direct materials, direct labor, and manufacturing overhead, it's also consisting of our raw materials account. So right here, I've got emboldened on the screen the direct materials used in production, the direct labor used in production, and the manufacturing overhead that was applied to production. This part right up here is figuring out how much raw materials were used as direct materials. Hope that makes sense to you. So let me start plugging in numbers. So in my raw materials account, I'm going to punch in my beginning balance in that account of $7,000. They tell us that they purchased $118,000 worth of raw materials, meaning that they had available $125,000 of raw materials to use in production. Now, this being a physical account, an inventory account, we can go in and count that we had $15,000 worth of ending balance. Now, whenever I'm dealing with one of these schedules, I'm going to put down the words less, meaning subtraction, and then over here, instead of putting minus 15,000, and I'll show you how Excel does this, I want to put that down in parentheses. That way, when it comes to me doing my sums, it's much more obvious what's going on to me. All right, so that means that they used $110,000 worth of raw materials for production. We don't have any indirect materials in this example, but if we did, if any indirect raw materials were consumed, we want to take them off. We want to subtract them, because what we're trying to figure out is the direct materials that were used in production. So if I do not subtract that amount of indirect materials, I'll end up double counting them. Because remember, they're going to be counted in our actual manufacturing overhead costs. We didn't have any, which is 0. So this is going to be the sum of those. Next, direct labor used in production. And they tell us right up here that our direct labor cost was $70,000. And then the manufacturing overhead costs that were applied, not that were incurred, applied, $90,000. So we had cost of production that were added to that work in process account of $270,000. I want to add to that my beginning balance in work in process. And then subtract my ending balance in work in process of $5,000. So I'm looking at these here. I started off with $10,000 in work in process. I'm adding in that $270,000. Then I'm subtracting my ending balance to figure out how much left that account. So $275,000 of goods were completed in the period. So next, I'm going to figure out my schedule of cost of goods sold. What was the cost of the stuff that we sold? So our finished goods inventory beginning balance is right here, $20,000. We manufactured $275,000 worth of goods. That means the goods available to sell was $295,000. Once again, I'm going to subtract my ending balance in finished goods. And that was $35,000. Once again, I'm putting that in parentheses so I know what I'm dealing with. So that means our unadjusted cost of goods sold is that $295 minus the $35,000. Our unadjusted cost of goods sold was $260,000. So I've got to figure out, was manufacturing overhead under or over applied? Well, my actual costs in manufacturing overhead were $80,000. Well, that go back over here. See right here, $80,000. The amount applied was $90,000. And so we're going to end up with a $10,000 credit balance. We have over applied manufacturing overhead. So if I've over applied it, that means I need a debit to manufacturing overhead to zero it out and a credit to cost of goods sold. So what I want to do is subtract $10,000. Sum those two up, and we get our adjusted cost of goods sold of $250,000. Next, I'm going to plug in my amounts for my income statement. Sales revenue, $524,000, giving a gross margin of $275,000. Our selling expenses, $140,000, and our admin expenses of $63,000. And we end up with a bottom line net operating income of $71,000. I hope this helps you guys. Do practice these. You may see one on the test.